Hello, entrepreneurs. This is Joe DeChara coming to you live once again from downtown Flushing, New York. And I am, yes, still here in the eye of the pandemic, the eye of the storm. The Actually not the worst place anymore for COVID. I heard that that's Brazil. But anyway, I am here bringing you information that's going to help you win at business, win big at business. That's right. That's what I do. I'm CPA, tricked into that by my father when I was 17 because he thought I was heading down the wrong road, and I was. But he told me that business CPAs run businesses, and that CPAs coach businesses. Actually, he said that other business owners go to CPAs for advice. And that's what I do now. So thank you, Dad. Thank you for tricking me, because I love what I do. I love helping small business owners, entrepreneurs, especially new ones, navigate the tricky roads of being an entrepreneur. And I am going to try something here. I've tried this in the past. Uh, but oh, here we go. I wasn't live in one of my feeds, I guess, but I hope I was live in all the other ones. Anyway, if you don't know me, my name is Joe DeChara. Like I said, I hang out here every night between 8 and 9, most nights. And what I do, like I said, is I help small business owners navigate. I help them put the pieces in place, how to put your business in the right sequence, if you may, so that you can make money. At the end of the day, you want to have more money in the bank than what you started out with. And if you agree with me, fine. Then we're on the same page. So if we have the same objective, and you like what I say, and it resonates with you, and you want to connect with me, because let's face it, I don't just do this as a hobby. I mean, I would, but I do want to connect with people. That's the whole purpose of having Facebook groups and Facebook Lives, and this is what Haley Gray taught me. So thank you, Haley, for putting me in the position to meet so many great people and connect with so many great people. So if you want to connect with me, this is what you do. You just go to Time with Joe, okay? Or you join one of my mastermind meetings. These are free twice a week. You just go to mastermindwithjoedechara.com, and we have a lot of fun. We did one today. There's a lot of aha moments. I always walk away from a mastermind meeting with something. Either we've helped somebody, somebody's helped me, or we've connected with people, and that's important. That's very important. It's one of the most powerful business tools that a small business owner can utilize. And there's all different kinds of masterminds. There's paid masterminds, but mine happen to be free. And a friend of mine, Sue Brook, actually has two free masterminds a week, and all you got to do is go to Mastermind with Sue. So if I was going, I wanted to get Mastermind with Joe, but that was taken. So don't go to Mastermind with Joe. Go to Mastermind with Joe DeChara. And so I decided to do something a little different tonight. I'm actually going to talk about accounting and taxes. I am a CPA. I'm pretty good at what I do. I am definitely out of the box. I don't do crazy CPA things, but I have a lot of CPA, IRS, tax problem, audit experience. So, I'm pretty adept at knowing what you can do, what you can't do, and everything I do is 100% legitimate. You know, it's easy to cheat and lie and put phony stuff in places. And, you know, if you're going to do that, I'm not doing your accounting work. What's not so easy is understanding and complying and capitalizing on all of the different tax rules. Okay. You know, it's tough to just run a business. And if you don't have a CPA, a tax person that's guiding you, you're definitely going to make mistakes. And let me just mention this, that a lot of people think they have an accountant, but they really have a tax preparer. And the difference is a big difference. The difference is a tax preparer prepares your taxes once a year. They're not doing any snapshots. They're not doing any bookkeeping. They're not looking at your P&L. You go into them. Hopefully, you know, you're going to get a refund. And you know, and if you only have a job, I don't mean just only have a job, but if you don't have a business, that's fine. You know, you don't need an account, probably. You know, if you don't have a business, you might not need to have somebody that crunches your numbers for you. Okay, but an accountant, what I do is I keep people's books and records in real time, or as close to real time as possible, because that's a good way to run a business. So that being said, what I want to do is what I'm going to talk about tonight is a topic that I used to not even consider: the office and the home expense. And I'll tell you why. Yeah, it's a nice deduction, but the way the business world used to be, it was a red flag, and it was definitely triggering. It would trigger an audit, and you don't want an audit, because basically what you're doing when you're deducting your office in your home, besides having to qualify, you know, and I'm going to show those to you, under different circumstances, who's entitled to deduct. Anyway, it used to be, you know, a red flag, and I advise people against it. It wasn't a good way to take business write-offs because they were showing up on your personal return. Okay, so let me show you what I'm talking about here. I'm going to share my screen with you, and this is kind of strange because I have this screen and it just goes. It's like having a mirror behind you and in front of you. So that's like a rabbit hole, I guess. I'm going to move that over there. And this is my Facebook thing. Oh, and this is what I was going to try to do, actually. Let's see if this will work, because I'm going to try to go interactive on Facebook. And if you know me, you know my story, that this has been a challenge from day one. And so let's see, are we here live? And if I'm not, it doesn't, oh, there I am. Okay. All right. So here I am. I liked it. So if you're watching live, give me a hashtag live so that I know that you're watching. If you're watching the replay, give me a hashtag replay. And if you have any questions about this topic, you can post them in the chat here, and I will definitely get back to you. I always get back to questions and comments and any other things you might want to throw in there, but I will definitely go back and look at the stuff. So, you know, this is the form that you have to fill out. Now, what I'm talking about is somebody that's a sole proprietor that wants to write off their home office expenses. And I mentioned that I used to shy away from this. I did not look at this as a really good way to take, deductions, even though they could be 1,000% legitimate. Okay. Now you might be saying, well, why wouldn't you want to take that? And like I said, because when you're a sole proprietor, you got to fill out a Schedule C form. That's your business form that's being reported on your personal return. So really what you're doing is you're commingling your personal return, financial information, with your business. And that poses some problems because you're under the jurisdiction of the IRS. And the IRS wants to know what you're deducting. And if they have an inkling that you're taking deductions that you shouldn't be, you're going to get an audit letter. And when you take a home office deduction, what you're doing is you're putting up a big red flag saying, hey, not only am I taking business deductions on my personal return, but I'm going to go one further and I'm going to take off what it costs me to maintain my home. And the IRS is sitting there saying, okay, you do that, and your chances of being audited just went up tenfold. So let me explain a little about what that means. The IRS audits returns, tax returns. They audit not-for-profits, and they audit them a lot because there's a lot of fraud with not-for-profits. They audit individuals. They audit individuals with businesses. And, they audit individuals without businesses. And they audit businesses, C Corps, S Corps, partnerships. So if you put them all together, we have to take out not-for-profits because they're in a whole different category. They're under serious IRS scrutiny, and there's a reason for that. Okay, and not everybody has a not-for-profit. Individuals that don't have a business get audited. Okay, let's say they get audited this much. Individuals with businesses get audited, I don't know what the number is, but based on experience, I would say probably 10 times more than just your average taxpayer that has a W-2 and some deductions. Corporations get audited very, very scarcely. Corporations do not get audited unless there's something really, really red flagging the return. And what do I base that on? No published statistics, no historical facts, based on my 35 years of experience working, for the first 10 years, working in some pretty large CPA firms. So I could tell you that over the years, I have personally handled thousands of returns, thousands of small business clients. Okay, and at one point, I specialized in handling audits. 98% of the audits that I handled were sole proprietors. When I was in the CPA firms, and some of those CPA firms, we had a couple of thousand clients. And if you figure, how many returns went through those offices, And when I look at how many of their clients got audited, there's a definite pattern. There's a definite detriment to being in business and being a sole proprietor. So that's why when we were talking about taking an office in the home deduction, it really wasn't a great idea if my client was still a sole proprietor. If there was, because if a sole proprietor comes to me, the first thing I'm going to do is advise them to incorporate, not become an LLC. You become an S corp. 98% of the time, that's the best way to do business, is as an S corp. Okay. And now this is the other thing. You know, some of the requirements and hoops that the IRS expects people to jump through are terms like, you know, regular and exclusive here, your principal place of business. And normal, you know, if you're doing your own return, you start reading this stuff, it's going to be like reading Latin, okay? Because I'm looking at this and I'm like, this is confusing as hell just to me, and I know what they're talking about. So what happened to change my point of view on this? Well, what happened is the economy changed. A lot of people, because of technology, were able to start working from home in their jobs and in their businesses. In fact, out of all of my clients, very few of them have brick and mortar offices or stores. You know, we're a work from home economy now. And after COVID-19, it's going to go up even more. So the amount of people that have legitimate, you know, home office deductions, you know, the IRS can't just say, oh, these people are writing off their homes, because the amount of people have gone up dramatically. So there's a lot more. There's a lot more. And there's only so many IRS agents. So, you know, if you're a sole proprietor, it's a lot safer now to take the deduction. But it's still not advisable. And let me just show you some of the crazy stuff that you got to come up with. You know, your square footage. They want you. You know, basically, you got to put all of your, what have you used this for business info. How big is the place? Is it, you know, 500 square feet or is it 5,000? What is it in relation to the rest of the property? And then you can start doing your calculations. Okay. So the problem still is, if you're a sole proprietor, that you're still putting this on your personal tax return, and it shows up like a sore thumb. Okay, and you don't want to show the IRS anything that they don't have to see. So the solution is, like I said, if a client comes to me and they are a sole proprietor, I'm going to make them a corporation. So the question becomes, well, if you're a corporation, how do you get the home office expense? Because, and you know, most people are going to think that, well, the corporation will just pay you rent. Well, no, that it's not that easy. And you don't accomplish anything by doing that, because when your corporation pays you rent, it's a deduction on the corporation, but now it becomes rental income on your personal return. So just paying rent to yourself is not, it just doesn't make sense. And I've heard some pretty, you know, sophisticated business people saying that, oh, my corporation pays me rent. And, you know, I don't know who their accountants are, but that's, definitely spinning your wheels. So when you have a corporation and you are using your home or apartment for business, okay, you can enter into an agreement with your corporation. And it comes really under the employee reimbursement type of what the IRS wanted to use it for. And so when an employee submits an expense report to a company, they can get reimbursed tax-free. We take that format and we make an agreement with our own company as the owner, employee. It doesn't matter if you're taking a salary or not taking a salary, but you are, let's say, an unpaid employee of the corporation. So I have a template to document it. You still got to keep books and records, and that's another thing that I teach. And it's one of the things that get people in trouble. And a lot of times having the books and records isn't as important as the process of keeping good books and records. Because, like I said before, you want to do business intentionally. You don't want to leave any breadcrumbs around. You don't want to have any loose ends. You don't want to have any open doors. And by going through these processes, like writing yourself out a contract, is just good business practices. So what you're going to do is you could just take and if you want this, like I said, you can connect with me. Go to timewithjoe.com. We'll provide you with a free chat, and I'll give you this info. So just go to timewithjoe.com and book a free chat with me. So this is the start of it. So you're going in, as an individual, you're going into an agreement with your corporation that you are going to be working for the corporation, and you're incurring business expenses because now you're doing business. I use one room in my apartment for business. This is my office. And 100% of what I do in here is deductible. I'm not writing off 100% of my rent. I'm writing off the percentage of it. But if I paint in here, if I get some new blinds, if any stuff that I do in here as repairs and maintenance are 100% deductible because it's directly attributed to this location. Same thing with furniture and fixtures, computers, anything that is part of or in the office. I could put a couch in here if I want, and it's a waiting room, and that becomes a deduction. Another thing, and this is another subject, but I'll just throw it in there. If you have something that you paid for, that you have, like closets, desks, furniture, chairs, and you could donate those to the business, and you convert them basically from personal property into business property. And that's one of the tricks I use when people start businesses. I convert as much as I can to business property because now what we're able to do is take a deduction, a business deduction, for something that you bought whenever. You already paid for it. It was a personal item. But because now you made it part of your business, you get to write that off. So let me show you the logistics behind it, the actual, well, okay, you can write it off now. How do you write it off? That's the $1,000,000 question. You don't go to your accountant with a pile of receipts at the end of the year. That's not how you write it off. And this is the easy way to write it off. And you got to get this into a system. What I would say is you do this once a month, just like a petty cash journal. This is this is like the maintenance of your business. I don't know if anybody, I just thought of that. I'm going to say, you need to have some business maintenance, just like a car. You need an oil change, once in a while. So this is part of maintaining your business. Now, what this is, this just explains a lot of what I just said. But let me go over this quickly. To take any business deduction, there's got to be a business purpose. You can't just write off part of your house because you own a business. You got to actually be using part of the house. And you can't just take any furniture and convert it to business. You're supposed to be using it for business. So the IRS says, listen, you're going to write off a portion of your house. It's got to be for business. Now, the question becomes, how do you document it? How do they know that you were actually in there doing business? Well, what I advise people to do is just take a picture. Take a picture of, the office, wherever you're working from, and that becomes part of your books and records, believe it or not. I have used photographs of my clients working I had an audit for a client that owned buildings, and I had pictures of her working in the building. And I used that in the audit, and it helped because it showed that she was actively participating in the business, and that audit went well. So, over here, and that's what I talk about, documenting stuff. So this is the actual worksheet, and let me show you how this works. So over here, and this is just a simple spreadsheet. I mean, you can do it this way, you can do it by hand, but as long as you have a document to back up the deduction, that's the important thing. People come in with bags of receipts, and they think that they're keeping their records. And the sad truth is that most of the time, a lot of that stuff is useless. Okay, because it's another story, but that's not a good bookkeeping system. Just keeping receipts is not a good bookkeeping system. The paper documents, the receipts, have to be tied to a transaction. Okay, and they have to be in order. And that's how you set up your books and records. And this is part of your books and records. So this is very simple. The green part is where you can actually enter stuff. And over here, what we have is the square footage determination. And let's say, so you see how that automatically went to that. And so now we have vendors and we have categories, and where I got those from is just over here. I just added them. Okay, these are vendors, different categories. These are the different things, types of expenses that you would have in the home office. And so over here, I'm going to pick here, landlord is rent. We're in 2020 now. So let's go to July 2000, and now it's not 15%, it's this one. Okay, so out of the $2,000 a month in rent, 7.5% of it is deductible. The deductible amount becomes $150. Okay. And so anything, so there's two different types of expenses. There's the direct and the indirect. So the direct would be, like painting the office. 100% of that paint is going to be deductible. I'm not painting the whole house. I'm just painting this office. If I need to do a repair in here, that's 100%, and that's what these would be. You see, so let's say I hired a carpenter. I paid $1,600 for the carpenter, and it's 100%. So all these formulas over here are, whatever the percentage is here is going to be calculated for this column. So I have my 100% items, and I got my prorated items. Okay, and you could see that, okay, the office now it's going to be 2,000 square feet. So all of that changes. Okay, so now these numbers have to be done. Obviously, I can probably do some more programming on this, but I just wanted to give you the idea. So if that's repairs, it's there, repairs, and we just come up with the number. Repairs. So this is furniture. Utilities. Let's say this is furniture. This is repairs. Okay, so we get the amount. Okay, the total amount is $6,000. 3,113 of that is furniture. Now, what you're going to do is, let's say you do this once a month. What you're going to do is print this out and actually cut yourself a check for this amount. You take it from your corporation and you reimburse yourself. So remember when I said that this system was really set up for reimbursing employees, but we can use the same format, the same methodology to reimburse ourselves for the office use of the home. Now, here's the stealth part of this, and here's why it's so much better to do business as an S corp or even a C corp. The IRS has no idea that there's office in the home expenses. There's not a special form like this one. There is no special form for a corporation. What happens is that rent gets classified on your books as rent expense. The repairs and maintenance go down as repairs and maintenance. There is no document. There is no red flag. There is nothing on the tax return to tell the IRS that you're deducting part of your house. So which way would you rather have it? Do you want the dangerous way, Or do you want the simple, less dangerous, safe way to do it? And that's my lesson for tonight. I hope I shared something good with you that you'll be able to use in your business. Uh, and if not, maybe you can, pass it along to somebody that it will help. And if you know anybody that I may be able to help with their business, with getting things organized and in order, and protected from the IRS, connect me with them or connect me with you. Go to timewithjoe.com, and I'd like to invite you once again to Mastermind with joe.com. And that's my story. I'm sticking with it. Have a good night. Thanks for watching. Appreciate it.